Samarth, there is this narrative that investors must go active to avoid the most indebted issuers. Why do you think this perception exists?
Because we made it that way. Index providers over the years have created market cap weighted indices. And that's an idea borrowed from equities, which again makes a lot of sense in the equity world, where you track market cap. But in fixed income, the dynamic shifts quite a bit. Let's think about what it really means. When we say the bond, the issuer that has the highest market cap, we're saying that this is the issuer with the most debt available in the market today. It's the most indebted issuer out there. Without looking at the quality of that debt, we're saying, let me hold the most of that. And again, I'm not saying it's a good or bad view of the market, it's just a different way to look at risk. And if I were to manage a portfolio, that's not how I would construct it today. So when we look to move away from this market cap weighting concept, if you are a passive investor, that's really all you have available today. Active fixed income managers intentionally avoid that trap, and they try to get rid of the overconcentration. But we could replicate these same strategies in an index format. So the new brand of indices we are developing at VettaFi are designed to be equal issuer-weighted baskets that specifically move away from this overconcentration risk. And when you invest in a product like that, you're not taking on that passive overconcentration that the market just gives you.
Pulling on that product thread there, to what extent can index-based strategies replicate the sources of active returns, such as illiquidity or risk premia, without introducing unintended biases?
Oh, very good question. So, when we think about replicating any of these factors in an index format, the key to me is persistence and harvestability. If we see any kind of risk premia that's consistently available, it could be captured in a rules-based format. So, things like credit spread premiums. These are very, very harvestable in the IG markets, both in the US and Western Europe. So when we look at those kinds of factors, we can wrap that around in an index format. Now, to be candid, there are other parts of the market, like illiquidity premium, that is challenging to capture in an index format. That's where our active counterparts do a bit of different work, and they're able to source securities that are not generally available for the index. So I wouldn't try to capture that piece in an index format, but there are certainly many other risk factors that we could include that are wrappable and that are persistently observable in the market.
Brian, which fixed income themes currently offer the most meaningful alpha out there?
Ebru, in fixed income, it's not always about alpha. You ultimately win by not losing, right? So finding the bonds or the issuers to avoid is actually more important than finding the ones that are gonna win, because there's a lopsided risk return profile. Thematics have not traditionally been an area of focus in fixed income, and even sector funds have never really taken off within fixed income. A lot of the reason for that is simply because the dispersion of yields and spreads between different sectors just isn't large enough to present real opportunity. So when we think about thematics, we're really focused on larger, wider economic themes. For instance, instead of chopping the world up into 10 different sectors, we may think of things as defensive or cyclical, right? Or in the new world where AI is disrupting many parts of our economy, and it's doing so very fast, we've really got to think about what are the industries that are less disruptible or more disruptible, and perhaps build themes around that disruption, or around areas of the economy where we believe that stable cash flows will continue to persist.